Hi. Oh wait, I think I'm in the wrong color. Give me a moment, yeah? So now that I'm dressed for the occasion, let's talk about what happened on Friday. So as I was preparing the presentation deck for this video, I was contemplating about the specific angle that I should come in with when expressing my market views. And when looking across the creator landscape, especially in this whole finance space, I do see two very polarizing ends. On one hand, you have people that are approaching the counseling approach, telling you to not panic sell, focus on the fundamentals, and to ignore the noise or many of these price volatility. While on the other hand, you have creators saying that, oh, I told you so, this drawdown might just be the start of something even bigger. So rather than try to plug myself into this very noisy landscape, I've actually decided to take a different approach. Because I really wanted to understand, when you're consuming such content on YouTube, what exactly are you looking out for? And for myself, a lot of time I'm just looking for some sort of a guide or some sort of actionable plans that I can do. So rather than try to push for a specific agenda on whether I think this would be a V-shaped recovery, like what happened during the Liberation Day of April 2025, or on the other hand, to express my view that I think this is a longer bear market to come, I want to stay neutral. I don't want to express a particular opinion or to share with you a particular thesis. So I do expect this video to be the first of a few video series that I'm going to put out in the next 2 days of what are the specific things that I'm going to do and to show you in real time through my own portfolio experience. And of course, you can follow along if you think this is a good exercise. Before we go into it proper, we do have to lay the context as to what was driving this huge amount of volatility on Friday. And if you were like me in a completely different time zone as the US market opening, I think the meme on the left is a very accurate representation. When you wake up first thing in the morning, check your brokerage app, and all you see is just an entire sea of red. And if you were curious as to what happened, the most convincing narrative thus far is that President Donald Trump announced the 100% tariff on all Chinese imports effective November 1st. And the long and short of it is that we are worried of a Liberation Day 2.0 that has took place earlier this year. If you're still paying fees for your trading and investing in 2025, come on. You're leaving money on the table. So Longbridge Singapore is changing the game for you. First, if you sign up today, you get to enjoy lifetime $0 commission on US, Hong Kong, and even Singapore stocks, and $0 platform fees. Second, you receive an exclusive 12% interest boost coupon for 90 days on deposits up to 2,000 Singapore dollars, plus an additional 18 Singapore dollars worth of cash coupon if you use my link below. And if you're aiming for additional stock rewards, the rules are pretty simple. Open the account, deposit, complete buy trades within the guidelines, and hold your funds. So on the first tier, you have to keep 2,000 Singapore dollars for 30 days and to make 3 subsequent buy trades. You then get to enjoy $40 worth of Nvidia shares and $40 of Apple shares. On the second tier, you deposit 10,000 Singapore dollars and maintain it for 90 days. 5 buy trades, you get $135 worth of Nvidia plus Apple. And on the last tier, tier number 3, deposit 100,000 Singapore dollars, keep it for 90 days, do 8 buy trades, and enjoy $385 worth of Nvidia plus Apple shares. So the rewards are not stackable, so pick your level and execute accordingly. And this special welcome offer is for new Longbridge Singapore users, and it is valid until the 31st of October 2025. And with this in mind, for my Singapore viewers, please go and grab your rewards today. And thank you Longbridge for sponsoring this video. And to bring you through a very quick flashback, roughly 6 months ago, during the whole Trump tariff tantrum, I've made a video with the title, I've lost roughly $28,000 in this Black Monday 2.0. And I do believe that this screenshot is very apt because it looks as if I'm facing my creator. And it was indeed my largest ever single day drawdown. So what happened on Friday, based on my consolidated amount, is that I was down roughly 3.7%, amounting to 14.7 thousand. However, this is actually a severe understatement because a large part of my portfolio resides in the Hong Kong market and it closed before President Trump made the remark of threatening China with the 100% tariff. So this amount, in actual fact, would be closer to over $20,000 if I were to map out the Chinese ADR amounts to their Hong Kong counterpart. So yes, it is a close second from that $28,000 drawdown. But I think an important point to take note here is that while we are laughing in our own misery, it's also important to zoom out and to have a better perspective of how far we've come. And when comparing to if I didn't invest that amount and just put it in the bank, I would have only ended up with roughly 270k. And through this entire investing endeavor or process, I'm still roughly up 6 figures. And in fact, I'm still slightly outpacing the S&P 500. For how long? I'm not too sure, but I think it's also important to ground yourself in this perspective that yes, we are all losing tens of thousands of dollars every day, but I think that's part of the process. And to lighten up the situation, I think these prevailing memes on X and some of these social media platforms really made me laugh out loud. So of course you have the Trump F your portfolio meme. And last time, a lot of investors and traders focus on the fundamentals and technicals of the company. But today, most of us basically just put our attention on President Trump's X account. And that P&L screenshot of yours, I think it would be a shame if I were to Uno reverse it. And yes, to give you some perspective, it is indeed a sea of red based on Friday's closing. But if to zoom out 1 month ago, actually it seems a lot more pleasant and a lot more palatable. It's still a bit of a mixed bag where you see some major companies like Amazon, Meta, Broadcom, Oracle, they're not doing very well. But you still see some pockets of greens here and there. And if you zoom out 6 months, it's a lot more positive because it is indeed the 6-month anniversary from that Trump tariff tantrum in April. And of course, if you look at it on a year-to-date basis, things actually still look pretty positive, all things considered. So I think the $1 million question here is to be a bull or to be a bear. And the balancing act here is really a lot more about we want to still participate and stay invested in the markets. But on the other hand, we also want to manage our drawdown or to manage the downside. We want to experience the least amount of pain when there's a lot of such volatility. So the funny thing is, when trying to strike some sort of a balance here, some investors might think or even try to time the market. And I do believe that some of you might succeed while others will actually miss the boat. And for the group of investors that didn't manage to time the exact bottom, you either swallow your pride and jump back in at a higher price, or you just stay out of the market and feel extremely jaded and turn into a bear. So this meme that I've seen circulating online is actually very, very apt. And based on my own personal network, I really do see investors jumping out from that April flash crash and have stayed out of the market since then. And of course, they are very excited about this current crash because they're telling you that I was right all along. But that said, I think based on how the markets has performed over the last 6 months, they've actually missed out of the entire recovery phase. So rather than trying to focus on the conversation about whether you want to be a bull or bear, instead, I think you can consider the following. First, I think go through a checklist and relook at your existing exposure or portfolio. Do you know why you're holding on to these current names? What was your initial thesis? And how do you feel about them today? What facts have changed since you last saw this company? Or is it just merely price movements? And it wouldn't harm for you to do a quick revaluation to see what are the current assumptions that are being priced into the stock today. And if you had no position today, would you still buy this stock? At what price and what size? Have you changed your mind about what you own? Are you over-levered? How much drawdown or margin can you take? And if the volatility persists for the next 3 to 6 months, would you be able to take them well? So focus on what you can control. And by the way, praying that this is Liberation 2.0 with a sharp V-shaped recovery expecting to come in the next 2 to 3 months is not something you can control. So the main question is, what's the plan from here on? So normally, when you look at some of this portfolio aggregation tool, whether is it from a brokerage platform or third-party software, you do see the breakdown of your existing stocks based on percentages, and you can probably categorize them by sectors or industries. Instead, here's how I see my portfolio. I think on the first bucket, for those of you who have followed me since donkey years ago, you probably will know that I'm a huge Chinese technology bull. 2 largest positions in my portfolio, which is both Alibaba and Tencent, I throw them under the first bucket called Chinese tech. And of course, not forgetting, I recently have added quite aggressively to my Meituan position. So if to add these 3 positions together, they make up the first largest bucket, which is under the Chinese tech name. On the second bucket, you have your US tech, which I currently hold Alphabet, which is the parent company of Google. I have Amazon, and I also have Meta Platforms. And they make up roughly 17% of the portfolio. On the third bucket, I have the semiconductor names, which include Taiwan Semiconductor, ASML, and Nvidia. And they make up the third bucket, which is 8.2%. On the fourth bucket, China Luxury, which is only one name under this category, which is Moutai. The fifth bucket, it's a China Plus strategy. China Plus meaning these companies also kind of tap onto the China recovery thesis, where they are big consumers of the brands, and they include Lululemon and LVMH. So they make up 5.4%. The sixth bucket consists of the index, which is VOO and VWRA, while the seventh bucket are my starter positions, which consist of Novo Nordisk, Eli Lilly, and Copat. So you can see that as I break down my portfolio, I do have my own specific naming convention and different investment themes to group certain companies together. And of course, I'm not saying that my way is definitely the right way, but at least it kind of gives me a little bit more perspective and ground me in terms of my own personal investment thesis. And in the second phase of this portfolio reflection exercise, after considering the individual categories, we then want to go into grading the individual names itself. So I've came up with this very simple traffic light system. Don't worry, this is not rocket science. Simply put, I just want to know your own personal vibes with the company today. So what I've actually did is to break down every single company in the portfolio. Intuitively, on the green zone, it's companies that you would continue holding or that you want to buy. The yellow zone is companies that you are kind of iffy about. You are not too sure whether you want to continue holding them or whether you want to continue adding them. And of course, in the red zone is those that are probably more speculative, companies that you don't really know why you're holding on to them. And this exercise itself will give you a very subjective opinion of your own conviction of your portfolio of companies today. So let's walk through the entire exercise together. And for myself, I do like to see them as some sort of a continuum because all these companies are trying to compete for my limited capital. So firstly, on Alibaba, I think they're still a very strong hold. I don't necessarily think of them as extremely or egregiously expensive, and they're currently riding on this very strong AI and cloud trend in China. They're the de facto number one player today, so I'll put them safely in the green zone. So I'll happily and comfortably hold Alibaba for the longer term. Same for Tencent. I do rank Alibaba and Tencent as the two largest juggernaut very safely in my green zone, so no doubts about them. So moving on to the third company, which is Google. I think specifically for Google, they are safely in the green zone as well, but relatively speaking, maybe I won't rank them as highly as Tencent and Alibaba. I don't necessarily think that they are a bad company per se, but considering the business quality, I don't think they are necessarily considered the front runner of this entire AI race. Yes, they are pushing very good growth in YouTube, in Google Cloud, in Waymo, so on and so forth. But in terms of valuations, in terms of the prospect of the business, I'm not as confident. So that's why I rank them a little bit lower than Tencent and Alibaba. Compared to Moutai as well, I think for Moutai, I do rank them slightly behind Google a little bit, maybe on the verge of that yellow zone as well. Whether I'll add them or not, I'm not too sure now. For Meituan, I do put Meituan probably more similar to where Google is at. I don't believe that they're as strong or as good as Tencent or Alibaba. I don't mind adding to them as well, considering their valuations. But I think the delivery war in China today is pulling back the company's prospects. For Amazon, I also put them in a similar category in the green but not so green zone. So similar considerations, but I do believe that they're kind of quite undervalued today. I do want to add to them. So maybe I'll move Amazon to the same kind of level as Tencent and Alibaba. For TSMC, I think for TSM, not saying that they're a bad business. In fact, they're a very good business. They've been a three-bagger for me. I would put them in the yellow zone now because personally, I don't think I'll be aggressively adding to TSM at current valuations. The current AI agenda is extremely good for the company. It's pushing the share price up. A lot of crazy compute demand and the chips order volume, they're just growing from strength to strength. But adding today at current valuations, I'm not too sure. I think jumping the gun a little bit for Meta, I will put together with TSM. When you look at the US tech names, I'm a lot more comfortable probably adding to Amazon and Google today versus adding Meta at current valuations. Moving to Lululemon, I think for Lululemon, I have been reflecting quite a bit on this position. You can say that I'm being affected or I'm being scared out of the position because of the price movements or price action. I am updating my thesis every single week based on disclosures, talking to their customers and so on and so forth. So I'm not as so-called quote-unquote confident about Lululemon now. I think still in the yellow zone. I won't throw them in the red zone, thinking of selling them out and wanting to observe them a lot more in the upcoming 3 to 6 months. Moving to LVMH, I think LVMH is closer to I would rank them closer to Moutai in this case. I think that they're a pretty good company. Don't think I will sell them anytime soon, but whether I'll add them or not, I'll leave them here first. I am a little bit more comfortable of ASML compared to TSM and Meta. So, and will I add them at current valuations? I think, yeah, a lot more comfortable than TSM, but I think there are better opportunities here as well. And also based on my own conviction about the company. And moving on to Nvidia, I will put them closer to the yellow zone. Not so much because it's a bad business. In fact, it has been one of the more fabulous ones over the last 5 years based on the importance of the business in the entire AI supply chain. But at current conviction and understanding of the business, plus the valuations today, I don't think it's a screaming green buy for me, at least for now. So for Copart, I think I am very interested in this business to continue adding to them. Maybe not as high as Google, so I put them in between this row and Meituan, Google, and Amazon. Moving on to both Novo Nordisk and Eli Lilly. Truth be told, I don't think I'm an expert in the pharma space. So for these two companies, I do want to rank them together in the sense where I don't have a specific leaning towards one company over the other, and I will probably park them in the yellow zone. A little bit more research needs to be done here. Don't think that I will be adding to them anytime soon, but it is a starter position anyway, so I will be keeping my eyes peeled on them. And I think through this very simple exercise, you can basically have an overview of your real thoughts around the portfolio of companies you have today, especially if you're managing positions of more than 10. Sometimes you kind of get distracted and you have to update your internal firmware into understanding where you sit with this company today. And from here, you can then go into the third phase, which is to take into consideration your portfolio allocation as well. So what we did here is basically trying to take an objective view of the business and whether we'll buy them today or not. Given how much you already have allocated in the business, would you continue adding to them? So for myself, let me share with you how I think about them. So clearly, my first two positions, which is Alibaba and Tencent, they make up close to 50% of the portfolio. So if you were to ask me, will I continue adding to them? I think on a more prudent portfolio perspective, I don't think I would. So I would move both Alibaba and Tencent down closer to the yellow position. For Google, even though it's the third largest position, I do still feel comfortable with them. So that's why I think I'll keep them at where they are. So in the green zone, if there are opportunities, I don't mind buying into them. For Meituan, I think it's the same. Specifically for Amazon, I do think that in terms of a risk reward, in terms of my allocation, I still can continue adding to them. They are currently a 6% exposure, so I'll move them down closer to the green section. So for these two companies, which is the healthcare companies, I think I'll keep them into the yellow zone until I'm a lot more comfortable with them. Then I will probably consider adding more. For Moutai, similarly, I think I will move them to the yellow zone. I don't have any thoughts about adding to them anytime soon. Could be considerations of valuations and lot sizes, so on and so forth. For LVMH, I'll actually bump them up closer to Meituan. I don't mind adding to them as well if the opportunities actually present itself. ASML, somewhere in between. Don't mind adding to them. Hope for better valuations. Copart, I will rank them closer to where LVMH is. So very, very small allocation today. I don't mind increasing my exposure by a very large extent. For TSMC, I think where they are at today, I will want to bump them down further. I don't think I will be adding to them. In fact, I might be rebalancing them out. So I think for Meta, it's the same case. So for both of them, I think I will put them in the lower tier of the yellow zone today. For Nvidia, I haven't really made up my mind. I think it's one of the best companies today. I want a greater exposure, but I'm not necessarily comfortable with their current valuation. So I'm not saying to sell them as well. So I won't throw them to the red or even the low yellow zone. I think I'll put them in the not sure pile. So not sure meaning like to KIV, to keep in view on where they present them the opportunities there. So for Lululemon, I think they are the trickiest out of the lot. Clearly, when I did the individual breakdown of the 15 different companies in my portfolio, I ranked them kind of like the quote-unquote lousiest, and so I will kind of put them in that same section with TSM and Meta. And this then gives you a much better perspective compared to just judging on these companies on an individual basis, if you take into account your existing allocation. So I do hope that this three-part process, firstly, looking at your portfolio on a broad category range based on your own understanding. Secondly, trying to break down the individual companies and to use a very simple traffic light system. And thirdly, to take into account their current portfolio allocation position and to understand what is your priorities in terms of your buying when opportunities actually present yourself gives you a better appreciation of your portfolio today. And just a few ending thoughts here is that I think all things considered on an index level, this is just a small 2 to 3% pullback. Is this the start of something larger, or how long is it going to last? I'm really not too sure. But if you're in high beta stocks, you're potentially seeing a 5 to 10% drawdown. If you're in the large cap crypto, maybe a 15 to 20% drawdown. And if you're in all the alternative coins, you're seeing a negative 50% and up. And they're just basically reflecting the risk volatility that your portfolio is currently undertaking. And truth be told, there are a lot of speculations on both sides of whether this is just the beginning or is it just a ruse to gain leverage in the November meeting. So for myself, I'm not in the prediction game, and hence I also don't opine much on how to look at the macro landscape and to do some of this tactical positioning. So most likely than not, at least on my end, we try to focus on tracking the company's fundamentals and their quality or lack thereof. Also, I think the reframing of the mind is very important here. So if you're value oriented, you want the market to give you discounts. So what are you exactly scared or afraid of here? And if you've done the work and deemed the stocks to be cheap at $100, now that it's gone to $90, you should be happy. Even if the prospects of it going to $60 look possible now, you should be loading the boat in that sense. So specifically, for the first part of this quote-unquote guide, it's a lot more about reflections. Reflecting about your existing exposure, looking at your existing portfolio, how do you think about them, and how are you intending to make the decision from there on. And if you guys are interested in the subsequent parts of what I'm intending to do in the upcoming 1 to 2 days during the weekends, comment below part 2 of this guide, where we will focus more in terms of updating our existing thoughts, the investment thesis of these different companies, and also an updated valuations of them. And in part 3, after reflecting and organizing our own personal portfolio, we will then look into the watch list of stocks that you're interested in purchasing. And with that in mind, I'll see you in the next video. But more importantly and hopefully, I'll see you guys on the moon. Goodbye.